Hi, everyone. This is Jason Bierk of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I'm excited to have him back on. He is John Williams of Shadow Government Statistics. I've been following his work for many, many years. He's been covering the old 1980s and 1990 formulas for money supply, for consumer price index, or the government's official inflation rate, the old formulas for GDP and the jobs reports. He's been sorting through the government economic data and coming up with the truth, I would say the truth. Thank you, John, for joining me again.
Thank you for having me.
So, John, we're recording this interview on Thursday, January 4th, 2024. Happy New Year to our listeners out there. I want to get your thoughts, John, on this narrative that's being repeated basically every day, Monday through Friday, for months now. The mainstream financial media, the PhD economists, Wall Street people, talking experts, people at the Federal Reserve Bank, BLS, they're constantly repeating that deflation is a major risk. The money supply is contracting in the banking system at levels not seen since the 1930s, approximately. And they're also saying that inflation, the Fed has tamed inflation with these rate hikes, and that the consumer price index inflation, I think it's around 3% now, but almost everyone who goes on TV now is predicting that it's headed back down to 2% or lower. Do you agree with this assessment?
None of it. I'm sorry to be a little more on the pessimistic side here, but I've been working and following with the government statistics for decades, and back in 1982, the federal government, the Congress, faced with a big boost in the cost of living adjustment, but back in it was 81, 82, because of high inflation. Decided to change the not the concept of adjusting the cost of living adjustment for inflation, but they decided to change the way they calculated inflation to reduce that over time. And the methodologies were changed very openly. It was discussed in Congress, and I took great offense at that because I thought there was some kind of an arrangement there where the Congress had gotten the people who are on Social Security to agree, okay, we'll take a cost of living adjustment for you based on the CPI, and then you get a bad CPI, and all of a sudden they start downgrading the CPI, and they continue to do that. The differential that the changes in definition have made, order of magnitude, is about 8 percentage points. So we're seeing headline inflation of 2% out of the CPI. It's probably closer to 10% in terms of common experience. Which makes a big difference. It helps the government with its deficit numbers, which are out of control.
Well, okay, so you said 10%. So what do you have using the 1980s and 1990 formula? What do you have the inflation rate at right now? Because I know what the headline number for the official inflation rate from the Bureau of Labor Statistics and the Fed, they're saying it's 3% and it's headed to 2%. You have it a lot higher than that, right?
Yeah, I have it. I don't have it right in front of me, but it's up in the 9-10% range.
And honestly, that feels about right here in reality for the average American everyday consumer or small business owner. I mean, there's still a lot of costs, input costs, John, that are going up. Wages for a lot of industries, the workers are wanting higher wages. Electricity costs are up. There was actually a good piece. I don't know if you saw it about a month ago. Bloomberg News put out an extensive piece. It was many pages. It showed a lot of different inputs for business owners, consumers. It basically disproved all the consumer price index that all these input costs the last 2, 3, 4 years, they're all up way over 20%.
Yeah. Well, that's I can believe that. I'm not familiar with that particular study, but it's certainly consistent with what I see in my estimations.
So why do you think then the government, the narrative then, they're saying that deflation's a risk? Why do you think they're saying that the consumer price index, that they have inflation beat? What incentive does the government have to do or stuff like this then?
The Fed wants to keep things up there because they need high interest rates. Or at least they'll keep the interest rates high. Where the actual inflation is, they can keep that low. They've got control of that. Whether it's up or down a little bit, it's far the headline reporting is far removed from reality. And then they can move that a little bit every now and then and change the way they calculate things in a month or change the seasonal factors. In fact, I've seen in the last couple of months they've just revised a month or two before where they should have put the other numbers going back in time fully revised, where it had some effect in modifying the headline inflation rate. The average guy doesn't believe what they post. The average guy's got a pretty good sense of what's happening. I found that over time. I mean, I've been doing this since the early 80s, and one thing I found is the average person has a pretty good sense as to how he's doing. And you can get all sorts of stuff out of the government and happy news that breaks through the newspapers. But if the average guy's not feeling that, he knows something's screwy in what's being reported. That's one thing that's helped drive people to what I'm doing.
Well, I would also add, John, that I think inflation is the number one or number two issue for almost all American voters in polling. So we're seeing that a lot of voters are still talking about inflation, but the politicians, the people here in DC, people on Wall Street, they're acting like inflation is done. I mean, the narrative going around now is that the money supply is contracting. And you were just telling me before we started recording that that's not the case at all, is it?
Well, it is in terms of how they report it. In terms of normal year-to-year reporting, you are seeing some contraction, at least in the broader measure. But let me bring things up to speed here. If you go back to the onset of the pandemic in 2020, circumstances were reasonably normal. You got into February, March of 2020, the Fed panicked and they flooded the system with liquidity. And they just pumped it up as high as they could. They put in everything they could. Then by the end of the year, you were up over 100% year over year in the money supply. We've never seen anything quite like that. That was very highly inflationary, still is highly inflationary. It's a basic factor behind the inflation that we've seen and are seeing. But what happens is that's, let's say March of 23 was when they started March of 2020 when the pandemic really hit. That was that's sort of your base period, and so you go a year later, go out to let's say March. Let's say we go to February of 2021, and you're going back to February 2020. Okay, you're up there maybe 120%. You go to March of 2021. That's going to start to sink because all of a sudden the year ago numbers starting to surge. Now, we may be down a couple of percentage points from the peak in the money supply surge, depending upon how you look at the money supply. But in terms of the hard numbers right now, and in fact, I'm going to give you some numbers here that are just hot off the press. This is on the monetary base, which is how the Fed drives the money supply, but by 110%. Against where you were before the pandemic. Year to year, that's up 11.9%, but that's up from 9% last month. Now that's in the money supply, which tends to lag the monetary base. The monetary base is really the controlling tool. I have what I call the basic money supply. The Fed played some very strange and unusual games here when the pandemic hit. Pandemic hit in February of 2020. In March, the Fed did massive stimulus, but they also redefined the money supply. And they shifted things around in M1, which is a narrower part, the more liquid part of the money supply, in the aggregate M2, which is that's being now the total money supply, so that you could compare the liquidity numbers going back in time. All of a sudden, you had a new series. The only thing I could do in showing and looking at liquidity, which is basically what drives the economy, was to look at the cash and the currency in circulation, which is they're part of the M1, but they're absolutely the most liquid elements. It's the only thing that's consistent in terms of the money supply history now, aside from the aggregate M2. So I just took what I called basic M1 against M2 as a measure of liquidity. That's the cash and currency people. That's what people buy things from. They don't liquidate their time deposits to go out and buy groceries usually. That money, that element of the money supply, the most liquid, which is what drives the inflation, right now is up 119% against where it was back then. Now, year to year, it's down 1.3%, but that's stronger than the M2, which is down 3.0% year over year. But again, those in the context of what's happened here in the post-pandemic, those numbers are not too meaningful. It is we've never seen anything quite like this, and it is what I see driving the inflation right now simply is the extraordinary liquidity in the system. If you look at this last month's numbers, and what I do is I take that what I call the basic M1, the currency, and the checking accounts. That's what people have to spend on whatever they're doing in terms of going out and buying things. As a percent of the aggregate M2, an overall measure of the liquidity as a percent, a 53-year high, and that's what's driving the inflation from the monetary standpoint. What's driving the inflation otherwise, I mean, that's from the Fed, and that's from the Fed's extraordinary money supply growth, and they put out a canard here. Back when they started having problems with the inflation numbers because of the tremendous money supply they started pumping in back in 2020.
Do you also think that government spending, so the Fed is funding both political parties, the White House, Congress, all this extra spending, because are you projecting that we're going to have, $2 trillion budget deficits going forward? Is that also driving this inflation money supply growth?
Absolutely it is. And that's the, you can, right now we're at a 50-year high on the, all-time high in terms of federal debt. I think we just hit $40 trillion. You're being hit from both the federal deficit spending and the extraordinary monetary stimulus still being put out by the Federal Reserve. We've never seen anything quite like this. And if you look at the Fed's claims over time that when the inflation started to pick up, this is that's due to an overheating economy. That's an absolute canard. The economy has not been overheating since the pandemic hit. It is still not overheating, and it's heading down sharply now, aggravated by the Fed's rate hikes to kill the overheating economy. But we never had a booming economy after the pandemic. The pandemic took care of the economy. It disrupted all sorts of things. The Fed's been playing games with their definitions and the way they've reported things here to try and keep the public happy. At the same time, they're doing their best to support the banking system. but the systemic liquidity is because of the Fed stimulus is high, which keeps fueling the inflation. At the same time, the high interest rates are doing a lot to drive the economy into the ground. And what we're seeing here is, to me, is quite frightening.
So I think you're talking, for listeners out there who might not understand some of the different terms you're talking about, I think you're talking about the discrepancy between the private sector, where you're saying the private sector is not doing well, versus government spending. Because aren't we seeing this also in the jobs reports? I think the majority of the job growth the last 12 months, according to the Bureau of Labor Statistics, the industry with the most job growth, it's government jobs and it's healthcare, right?
Yeah, and it's the influencer will be getting some. We'll be getting some new numbers in a couple hours on the jobs report. There are two series that are very heavily have been very heavily redefined over time to give you the best numbers possible, and they're not always accurate. One is the unemployment rate, payroll numbers, and the GDP. And the GDP is probably the worst, but it's the item that the government tends to concentrate on. If you believe the headline numbers on the GDP, gross domestic product, broadest measure of the U.S. economy, year-over-year growth adjusted for inflation in this last quarter was 3%. Strong growth, good growth. But there's a problem there. There's a secondary series which is absolutely mathematically the equivalent of the GDP. It gets reported a month after the GDP. It's called gross domestic income. One's the product side, they measure the production. The other is the income side, what's generated by all that. And where the GDP was up 3% year over year, gross domestic income was down 1 or 0.2% year over year. The discrepancy of about 3.2%. Worst discrepancy ever seen in the history of the series. I mean, that's the GDI, the gross domestic income, and the GDP are supposed to give you the same numbers. Now, there have been times before when there have been discrepancies, and then there are times when you see different flows with the income and the production. The last time you had the worst discrepancy seen before that, I think, was around 2.3%, plus or minus. That was at the onset of the Great Recession. When you start seeing a discrepancy here between the GDI and the GDP, the way we're seeing it, that often is a negative economic sign. And again, last time you had that signal, you had the Great Depression. And that's, I think not the Great Depression, Great Recession. You didn't have these series back in the times of the 30s and the Great Depression. But in terms of modern economic reporting, it was the worst downturn we've had. And I think something like that is in the offing here. We're seeing all sorts of signals in it, because if you look at the monthly series, and they're the better quality series, the retail sales, industrial production, housing starts, those are often industry numbers. Adjust them for inflation. They're all year over year flat to minus. You're not seeing 3% growth in any of them. And if that GDP number was accurate, you should be seeing 3% year-over-year growth in a number of those series. Not happening. So I'm looking at a very unusual discrepancy here in those numbers, and I'll go with the monthly numbers that I believe over time, and I've seen over time, have worked out a lot better. I mean, you have some problems with those monthly numbers. But particularly where they come out of private industry. You look at the cash freight index. How can you have a booming economy when the freight index is down 10% year over year?
Well, also,
GDP and
Well, also
I'm
look at
sorry.
the jobs report numbers. The jobs report numbers, John, are they counting the part-time jobs as the same as full-time jobs? Because if we look at the headlines for the a lot of these large banks, big tech companies, a lot of these companies are firing tens of thousands of people, and yet the jobs numbers are positive, but it seems that a lot of the jobs numbers are counting part-time jobs or government employees or healthcare jobs that are related to Medicare or Medicaid or some other type of Bidenomics government spending program. They're counting those jobs the same as a higher paying full-time job.
Well, they count people as employed, and if they're employed, it is in theory a count of the employed people, but it's not inconceivable that you get people with part-time jobs or multiple jobs being counted a couple of times as employed. That's not supposed to happen, but it does. There are a lot of issues with the employment numbers. Let me put it this way. Have you ever heard of generally accepted accounting principles?
Yes, well, I know for a fact that the government doesn't like those.
No, they don't use them. I mean, the idea is that if you change your accounting method, what you do is that you at least restate things so that people have a way of comparing the numbers from period to period. If you just change your definitions as you go along, you can come up with anything that you want that has no meaning whatsoever. And unfortunately, that latter case is what we're seeing with some of these.
Yeah, I've heard
Some of
you.
these.
Well, I've heard you
The,
talk with the. I've heard you talk in interviews, other people's channels, podcasts, and my interview with you about the PhD economists at the Bureau of Labor Statistics and how many adjustments they do. I think the average person, the Wall Street trader, I don't think they know or care how many adjustments, how this input data is being adjusted. And in a lot of these formulas with the consumer price index, the government inflation data, whether it's what substitution, hedonics, geometric weighting, all those formulas are all types of adjustments, but the input data is even being adjustment because the government is basically cherry picking what goes into the formulas first, right?
that's correct. And as a result, you get happy numbers. These guys are politicians. That's their profession. God bless them. I have no problems with politicians. I understand them. I think most people understand them. But if you were a business and subject to audit, you would need to follow generally accepted accounting principles, which would mean reporting numbers on a consistent basis time to time. They don't. So what I've done is I've gone back. I'll tell you what, they're very honest about their changes. They come out and they publish and say, here's where we made changes, and then we estimate that this knocked down the cost of living adjustment by 0.3% or 0.5% on down the line. I've never seen an adjustment that they've made where it actually increased the reporting. This goes back to the 1980s, and God knows how many changes. But that's what got me into publishing alternate numbers, because when this big cost of living adjustment hit in 1980, they decided to knock down the CPI. Catherine Abrams, who's in the head of the BLS, in her memoirs noted that Newt Gingrich said, "Gee, if you could find a way of calculating this number this way, we might be able to find more money for the Bureau of Labor Statistics." That's what she said in her memoirs. Now, whether or not it was changed, well, I know it was changed, but I mean that's the type of stuff they were using. My goodness, you did that in the private industry, you'd end up in prison.
Yeah, it's accounting fraud. Do you think then
Yeah.
that the definition of a recession the government's going to change the definition of official recession then?
Well, I don't know that they're going to change it. What they've changed is the reporting of the GDP. Let me put it this way. There are several advantages to understating inflation. One is it reduces cost of living adjustments, which helps in terms of the budget deficit. But when you look at most of the economic numbers as a reported headline, you look at retail sales, for example. That's in current dollars. That's in dollars as reported by the companies making the sales. But if you want to come up with a measure of how strong the economy is, you need to deflate that for inflation, put it in what they call real terms, adjusted for inflation, and then you can see how it is with all the inflation pressures removed. That's why the headline GDP, gross domestic product, broadest measure, that's in constant dollar terms. That's adjusted for inflation. But if you reduce the inflation number, that has the effect of boosting the inflation adjusted or the real growth. So that if you're understating inflation, which the government is, even adjusted for the headline CPI, the retail sales, well, even adjusted for the headline CPI, the retail sales has been negative year over year, but it's a lot worse than being reported. And there are numbers that are so positive because of the understatement of the inflation that's used to deflate them. It's not done on a consistent basis.
So this sounds like a train wreck. Sounds like the real economy is basically in a recession, dealing with inflation, a lot higher inflation than the government is saying. So it sounds like, or you say around 9%. So that sounds like serious stagflation. Do you expect something similar to the 1970s where inflation then increases again in waves?
I'm sorry, could you say that again?
Do you expect, it sounds like the real economy then is already in a recession, especially if you subtracted government spending, because that's being counted as positively for job growth and for GDP. And then they're announcing accounting a much lower inflation rate. Do you expect inflation then to heat up again, increase again in waves similar to the 1970s stagflation?
Probably worse. I'm looking for really an inflationary recession, possibly depression. I mean, it's the same direction. Just I think we have ahead of us something that's will unfortunately be remembered for decades as one of the worst economic and inflation periods of modern history.
Would you say that the majority of this is because of government spending at this point? Because it seems that neither political party, the White House, neither political party in Congress, Republicans or Democrats, want to cut spending, and the budget deficits are just going out of control.
Well, yes, that's I think you can attribute this very much to the people running the government. The one factor that you have to consider here is that you did have a pandemic, which is a very unusual circumstance that had major impact. The government responded with it triggered where things were already excessive in terms of the way the government was spending, the way they're playing with the numbers. It's exacerbated the circumstance, so that this I think is going to be a very uncomfortable negative period. A lot of it will be attributable to the way the government's handled things, but you also have to allow for the fact that a part of it is still tied to the systemic disruption from the pandemic. That I don't blame per se on the government. It's just one of those things that happens.
Do you expect more of the budget and GDP? Is it going to be based on government? So are we headed towards where government spending is going to make up 50% of GDP in the next couple of years? Are you projecting something like that, where there's going to be like a very large percentage of the economy is going to be based on government spending and socialism?
Well, I think it's going to move more in that direction, but unless you get the Fed to bring its money supply under control, and I'm not talking year-to-year changes of minus 0.3%. When you've got where the money supply, the most liquid measures are up 120% from where they were before the pandemic. And we're seeing right now, I mean, I'm telling you this, Thursday afternoon, they report the monetary base on a weekly basis. They used to report the money supply on a weekly basis too. And I could be giving you those money supply numbers today as well, if they hadn't changed them when they flooded the system with liquidity. They knew what they were doing. They knew what the effect would be. Seeing the effect, we've seen the effect in the inflation. The inflation is still understated. But going forward here, they have to bring it under control, or you're going to end up in a hyperinflation. And I'm not seeing. I'm afraid they may not be able to bring it under control. I'm afraid we may see some much higher inflation down the road, at least as people will recognize it. Once it gets out of control, they're not going to be able to contain the reporting much. Very high inflation ahead, and at the same time, a very weak economy. I see this as being one of the. You take a weak economy and high inflation as negatives for the average citizen and his economic lifestyle. It's going to be a difficult time.
Yeah, it sounds like best case scenario is a lot more stagflation and shrinkflation and then more formula changes. So you just described over the last 25, 30 minutes, a lot of different formula changes that, yes, they're disclosing them in footnotes, but it's not talked about by Wall Street. It's not talked about by politicians. It's not talked about on business television. No one talks about any of the footnotes that the Bureau of Labor Statistics discloses. They only talk about the headlines.
Well, it's people tend to. If you're in business, you generally don't advertise bad things about your business outlook, and with the government, they have the ability to actually put a little puff in there in terms of the headline reporting, which gives them some advantage over the private sector.
So I get asked questions about this all the time with the consumer price index. Does it account for things like shrinkflation? So shrinkflation is where like the portion size at a restaurant, and we're seeing these articles come out about like Chick-fil-A, McDonald's, where the prices are still rising. The consumer price index isn't reflecting this. The portion size, the quality of the food is going down. The price stays the same or goes up. So it's cost per unit. Is the consumer price index actually accurately measuring or accounting for like cost per unit changes for the consumer?
No, it's not. Let me put it this way: there are ways that it probably, I'm sure it is being measured, and that the numbers are accurate. But in terms of the weighting and over time and how that's handled and allocated, it's not. And if you, again, you can go to the BLS website, and they actually have what they call a research series, CPI research series, which, if you go back through it, shows again, they're straightforward in terms of what they've done. It itemizes the things that they have changed, made changes to that affected the CPI, as the headline CPI as they see it. And they'll describe the change, and then we'll estimate what effect that it had on the aggregate CPI, or is having on the aggregate CPI. All the changes that they've made have had the effect of lowering the headline inflation. I've never seen one that has upped it. And what I do is I just effectively reverse engineer the research series. I use their numbers as to the impact of what they're estimating the changes have made. So I'm just putting it back to where it was. And effectively, what what I've put out there is something akin to what you'd be seeing in the CPI if they hadn't made all these changes starting back in 1982. I'm not going out and making separate surveys. The government makes tremendous surveys, and
Yeah,
they're rather honest about what they do. But they tell you what they're doing, and what we've done here, that's going to knock 0.5% off the annual CPI. I add it back in.
Yeah, for the listeners who are not friends with PhD economists and don't have conversations with them, and I've had a lot of discussions with them on and off the record over the years. I mean, they do a lot of adjustments to the data set. So like the input data, the formulas, the weighting. So there's a lot of this going on here. And then it's not people just the headline numbers are traded on. The business television only talks about the headline numbers. Hardly anyone's digging into the numbers. Occasionally, maybe in a few shows here or there, they talk about how like the jobs growth the last 12 months is government employees and healthcare, but you don't or how like the jobs reports, John, another big one is the jobs reports, every 1, 2, 3 months later, they're revised downwards by 50%.
Well, let me put it this way. I have there's some things that are very arbitrary in some of the surveying, like the jobs report. The government does estimate longer term or broader. They have broader unemployment measures. They have a U3. The U3 is a headline, and they have a U6, which measures includes discouraged workers. These are people who want to work, but they can't. There are no jobs to be had, or at least that's what they feel. And if they're discouraged and they've given up looking for work because there are no jobs to be had, they're included in the U6 measure, which is higher than the U3. But after, I think it's 6 months, if they're still discouraged, they just drop them from the numbers. And I put in my own estimate. I mean, I've been using the government's numbers again. But if someone's discouraged for more than 6 months, that's sort of arbitrary. There are areas of the economy that have been heavily hit for a period of time, and people can't get jobs although they want them. So I have a much broader measure. It gets up closer to 20% over time. These are people that have been dropped from the government's reporting, but these are still people who are discouraged and would like a job. So,
well, also
no matter how you define it.
Well, also, John, the government doesn't account for if, let's say, you were making $200,000 at, say, a bank or a big tech company, you were making a mid 6-figure salary, and then you just got laid off, and then you ended up taking a $60,000 or $70,000 a year job at much lower paying. Then the government counts that as still employed, right? It doesn't make a proper, I'd say, real world adjustments for how the person just lost over 50% of their monthly salary.
Yeah, I agree with you, but it's I don't know that they have enough adequate surveying of that to really give you a good reading. I mean, it's a very good point, and it's probably the type of thing they should have in their surveying.
Well, this is what we're seeing now, because look at the headlines, John. The last 6 months, the banks, there's over 60,000 layoffs at the large banks, and the big technology companies are firing like crazy.
Yep. Let me put it this way. The economy is a lot weaker than it has been reported. It was never overheating as the Fed claimed, trying to blame inflation, which it created with its money supply. Tried to blame the inflation on the overheating economy and used that as an excuse to hike the interest rates, which, although depending on how the bank's investment strategies are worked out, could cost the bank some money, but over time they'll tend to be able to make higher profit margins with higher interest rates than they can with the low interest rates. So the Fed's owned by the banking system. It does everything it can. It has to keep the banking system afloat. I certainly want them to keep the banking system afloat, but the numbers get adjusted for the benefit of from the issuing parties. It's not that anyone is held to accounting principles, as you mentioned. So.
Well, also this time you mentioned that the banks would have higher net interest margins if they raise, if the bank's cost of capital is lower, and then they can lend out at higher rates. The problem this time is all this office space, the commercial real estate bubble that we've had, because the banks were all projecting cash flows and rents at certain levels. I think now with the higher interest rates, I think there's a commercial real estate bubble. I know you're out there, in San Francisco, Silicon Valley area, right? So there's a lot of technology companies that can't raise money anymore. So all those office spaces, San Francisco is one of the worst, right, for commercial real estate bubble and empty office buildings.
I'm not an expert in that particular area, but what you say sounds right from what I have heard.
Well, I'm speaking off the record of bankers, and I mean, like, you're talking about accounting games and generally not doing generally accepted accounting principles. Yep. I mean, there's the banks, the insurance companies, pension funds. I mean, they're sitting on like tons of losses for office buildings, multifamily. They're not marking to market any of these things. So like they need the Fed to cut rates, and they need to renegotiate the mortgages on some of these office buildings ASAP.
Yes, that makes sense.
Well, John, it does not sound like an easy economy and an easy markets or investment future to navigate. But it sounds like the government's going to fund itself and the Fed's going to pay for it no matter what. That this spending is just absolutely out of control.
Yep, and unfortunately, from the consumer end, that's likely going to mean so much higher inflation. So the fact what they're doing there, it gives them the liquidity with it, current prices, but it also triggers higher inflation.
Yeah, I think best case scenario, unfortunately, is stagflation. So we'll see what happens. I mean, if the Fed, a lot of people think that the economy will improve, the stock market will continue to rally or start a bull market if the Fed cuts rates. I mean, normally, don't they only cut rates if like banks break or something big breaks normally?
Yeah, usually they cut rates if there are problems. Well, in some instances they really want to raise rates because that'll affect, can help the bank profit margins. But the idea of when they start to ease, assuming they've got the banking system stable, and they've made some progress in that, I think. But we'll see. But it is the high interest rates are lethal to many businesses. Raise interest rates, that's usually a killer for the economy.
Well, this time I think the rate hikes are not helping the banks. There was actually an article out in Bloomberg earlier today by the Bill Dudley, who I think was a former president of the New York Fed, and he was warning there's still a bunch of banking system problems. The majority of problems, in my opinion, they were the bond losses that were occurring the last couple of years with the bond market. The banks didn't mark to market all those losses. Everyone's like, oh, they'll held to maturity. It's fine. They won't mark to market. I think the main issue here is commercial real estate from what I'm hearing. I mean, there's just office buildings that are empty everywhere. Everyone had, like, for real estate investors, use a lot of debt. The cash flows, the rents, it's not there. And so like we're looking at another real estate bubble, but this time it's commercial real estate, office building, and multifamily.
That's credible.
Yeah, and so I think shadow stats is a very important measure here because unfortunately I just get in arguments with trolls about like the government headlines. They're like, oh, there's full employment. Oh, the economy's fine. Oh, the inflation is down. What are you talking about? And then I point to your work and I say, look, if you pay your bills, you're a small business owner, you pay your bills. I mean, the inflation rate's not 2% or 3%.
Yeah. Well, one of your best indicators here is the average guy, and I mean you can put out all sorts of happy numbers from the government, but if the average person is not realizing the purported benefits, they know it, and there's a very good measure one of the best, I think, fundamentally, from the University of Michigan, their consumer sentiment measure. That fell that fell sharply with the onset of the pandemic and the resulting recession. It's never recovered. It's still order of magnitude 30% below where it was at the time of the before the pandemic hit. And till you see that getting back above where it was before the pandemic, you're still in recession or depression, whatever you want to call it. It's a very good indicator of underlying reality.
Well, another thing here also is that these credit card interest rates and all the inflation that we've accumulated, like you said, since 2020, and there was inflation obviously before that, but it accelerated, I would argue, like you said, starting in 2020, the last 2 or 3 years, there was even more stagflation and shrinkflation than since 2008. So I think that consumers they don't have the discretionary income, their standard of living's being squeezed, and that's translating into polling for the 2024 elections as inflation in most of the polling I see, inflation's one of the top 1 or 2 issues for the economy.
It is, and you had a funny bounce around there in the sentiment this in December, where all of a sudden there's some hope that maybe there's going to be some inflation relief. I don't think that's going to last. Is what you're saying. What you're saying. You go back before the midterms. You're seeing a high inflation rate, and it's still. I don't care how you look at it. It's not stable. And I'll still go by my numbers. But what the administration did was they depleted the strategic petroleum reserve, knocked it down by 47%. Put that oil into the system and knocked down oil and gasoline prices. And gasoline prices were surging right before the election. So that has helped to bring down some of the inflation, but it has also raised some longer-term concerns as to the risks of the system to the system. There was a reason for the strategic petroleum reserve as it was, and now they have a program when oil prices get low enough they'll restock it, but it's not being restocked, and that one shift, liquidating that oil, and then they exported it, which had the effect of reducing the GDP, lowered the headline inflation rate, and boosted the economy. It was still having some impact, and that's all happy news, but it's not based on underlying strong fundamentals. It's a short-term gimmick, which has also reduced national security.
Yeah, I would agree. The oil from the Strategic Petroleum Reserve has been heavily politicized. I think Trump was doing it too. There's been a number of different presidents and administrations doing it. So it's ridiculous that it's politicized. It's supposed to be used for emergencies, for national security purposes and safety, like you said, in case there's a war or there's an oil embargo, or one of our main countries that we import oil from doesn't export oil to us anymore.
Yep. Well, it did have some. It did boost the GDP some a couple of quarters ago because we exported it, and that brought down our net export deficit, which is always a negative in the GDP. But if you look at the distorted reporting in the GDP and the real strange reporting we're getting on the CPI right now, I think you're going to see some very sharp reversals in the year ahead, both in terms of economic activity that will be exacerbated by sort of reversing the process before, and as well with the other numbers. How far ahead of the election remains to be seen, but it was the changes were done pre-midterm election. God knows what they're going to do before the presidential election. But it can't be done easily now. It's not as easy as it was back then.
It was either October or November. They did a ridiculous adjustment on the consumer price index. They adjusted the healthcare costs for people in the consumer price index down by 34%. But here in reality, the only thing that I see potentially falling is what the oil prices are down substantially. They're in a low trading range. So that's going to be what temporarily low gasoline and diesel prices. So that might be the only input cost I see in my own bills that's actually falling.
Yeah. Yeah.
Well, I really enjoyed our discussion today, John. I'm going to put links to Shadow Stats. Are you up on Substack now? You have a backup now for your website? Because I remember over the summer it crashed.
The shadowstats.com website is up there, but it's not interactive. I mean, you can go there and you can look at the 20 years of commentaries. What I'm doing right now, I mean, this is a site that was designed 20 years ago. Our web host went out of business with little notice, and we moved the site to a new web host. But our programming was ancient enough that it didn't work too well. So I'm rebuilding the site, but at the same time, everything that I've had on the site, I'm now providing to subscribers by email. Get a weekly email summary of what's happening in the economy, the graphs of the latest and an analysis of the latest statistics, alternate data tables on the numbers that the government puts out in my assessment of them, the CPI, the GDP, money supply, and it's the same cost as before, $175 a year. Actually, I'm offering a special right now you get 2 years for $175 if you subscribe now.
Very good. Well, keep up the good work. And it's just refreshing to hear someone going through the data, because I'm tired of people telling me that inflation is dead and that I'm overly pessimistic. I mean, the stock market, I view the stock market, the asset price, is very, very different from reality, especially for the private sector. I live right outside of Washington, D.C. This place is a bubble. It's divorced from reality. The government spending here, it's basically, if you look since 2008, the government spending has gone parabolic along with the national debt. And that's good for the DC metro area. I would argue that's bad for most of the rest of the United States.
Well, could I make one last point for what it's worth on the inflation? I found, I'm happy to provide anyone with the plots in my CPI versus the government's numbers. But what I found was that if I plotted the CPI against the price of gold, I found this completely by accident, and just using the headline CPI and my CPI. My CPI and the headline CPI are basically the same before 1982, before they had all the changes. And then when I plot my CPI against the headline CPI, mine keeps rising while theirs starts to taper off. And I thought it'd be interesting to plot the price of gold against the CPI and my headline CPI. And to my shock, I mean, I knew they moved closely, but the headline, my CPI and the price of gold tended to move together. I didn't have to even change the numerical levels, where the headline CPI leveled off, and the reason was just, it was a pure coincidence. But the price of gold and the basic CPI unit, which was the same for both mine and the government's. It was the same back when Nixon abandoned gold. The gold standard, same month, the CPI, the price of gold, all averaged out the same. So if you that's a chart I'm happy to supply to anyone. But when you look at it, what you'll see is that where gold and inflation have moved along over time, they start to split in 1980, with the headline CPI sort of flattening out, and the price of gold and what the old CPI would have shown continuing to rise exponentially.
Well, the government CPI, the gold price hasn't kept pace with the official government consumer price index number. That the gold price in U.S. dollars, it should be well over 2,300. I mean, it should be over 2,500 if it was inflation adjusted for the official government CPI. I mean, my opinion is there's overwhelming evidence that the paper gold price is manipulated to make sure it doesn't keep pace with the official government, the current government's consumer price index number. Otherwise,
I'm not saying that the gold price isn't manipulated. I'm just saying that it does. I'll send you. I'll send you the graph, but it is there are a number of factors that are affecting it, but it does move. If you look at the level. I'll send you the graph. It moves with the gold moves with the actual CPI, the way it used to be measured, not with the headline CPI.
Yeah, and
I'm not arguing that gold isn't understated and played with by manipulators, but over time it does catch up. And then my point is that if you want a solid hedge, hedges I can recommend against inflation, I would still look at holding physical gold. Not buying gold futures or such, but just holding physical gold.
Well, the younger adults are buying Bitcoin instead, but I'm not all in on gold or silver. I'm not all in on any one thing. So I do own some gold and some silver, some gold stocks, not mining companies, royalty companies, and then some Bitcoin. So I'm kind of diversifying here.
Okay. That sounds pretty good.
But I want to thank you so much for your time today, John. I think my listeners are going to get a lot out of this. There's just a lot of adjustments into this data that the politicians, the people at the Federal Reserve Bank, the people on business television, they're just not talking about. They talk about the headline numbers because the headline numbers puts a spin that like the economy's doing well, people are fully employed, inflation's coming down, the Fed has done an excellent job. That's kind of the narrative, and it's been this way for a very long time.
Yep. You're right.